Glen Smith is CIO of GDS Wealth Management, joins us with his take on things. Glen, lovely to have you on the show. Thank you very much for your time. What is your own read on how to prepare for next week, really, in the wake of those impending tariffs, which President Trump's administration have time and time again said are universal?
Well, we're going to see it could be in two phases, and it's been very fluid, right? There's different reasons for potential market pullbacks. In the last 75 years, on average, basically since World War II, the average every year has about a 14% drop. So this 10%, while the reason being the tariffs is a little bit different, there's always a reason for the market to be a little bit volatile. We're trying to digest all the information. We think there's going to be certain sectors out there that could be winners with this, certain sectors that are going to be hindered. So we're still trying to take advantage of it. A lot of stocks out there right now are already priced as if all of the tariffs are going to be in place basically into perpetuity. There's a lot of stocks that have dropped. So you can use that to your advantage and be picky and try to buy things on sale, on discount.
On discount. Okay, so what are you looking at? What's your shopping list like?
There's many stocks. So one stock specifically, I'll use an example as a tariff I mentioned, Hewlett-Packard Enterprises. It's a bit unique. It partnered up with NVIDIA last year, and we think that's going to be a huge partnership. They manage your data, application, storage, cloud services. This is a way to be in AI, in the cloud, with a stock that doesn't have a crazy multiple like some of these other technology stocks. It has a bit of a dividend, and in fact, they're growing at double digits every year. The reason they came down is they did lower their guidance for 2025, and one of the main reasons the CEO mentioned is the tariff. So if that's already priced in to a large extent, this could be an opportunity, not a catastrophe.
Glen, do you feel that the bottom is already in for this year?
We never put our finger on exact where it's going to hit on the S&P 500. What we're trying to do is take a long-term approach. It's been a lot of information going on in the last 90 days, so we're trying to digest it and look at where are we going to make the most money for our clients over the next 4 or 5 years, not over the next 6 weeks per se. In 2 months, the tariff conversation may totally change. So we're not trying to exactly predict the exact bottom, but just realize as investors, there's always opportunities. And last thing, I know you probably saw that it was just announced that consumer sentiment was down. That's actually a good thing. You know, the consumer sentiment's the lowest it's been since 2013. The S&P's 4x since then. Why is that a good thing? That's a contrarian number. Historically, when consumer sentiment is poor, stocks tend to do fairly well because consumer sentiment is rear view looking. So I'm not saying we are in the bottom, but we see a lot of opportunities, and you don't want to try to be cute and get the bottom. You just want to start picking stocks that are on your shopping list as you see opportunities.
And you've also got JP Morgan on the shopping list.
That's right. JP Morgan's been one of our favorite stocks for a while. Net interest margin's amazing. With the tariffs, we think there's going to be some inflation, which is going to not be great for the whole market in general. But that means that probably rates won't come down quite as quickly. So for net interest margins for the financial sector, that might be a little bit of a silver lining for them. The net interest margin should be high. Mergers and acquisitions should pick up. Even though JP Morgan's up 30% over the last 12 months, we think it's still super attractive. It has a PE of 12, has a dividend. So even if we're in a secular bear market for the next year, you're still making progress towards your investments.
And you've already got another name there that we can talk about on the list when we come back. But we've got to take a very short break right now. Glen Smith from GDS Wealth Management is staying. Well, let's get back to our guest. Waiting in the wings, we have Glen Smith, who is the CIO of GDS Wealth Management. Glen, thank you so much for patiently waiting by. You were telling us earlier how it's difficult to time the markets perfectly, and it's also difficult to know whether or not, a couple of weeks ago, we saw the bottom being put in for this year. The best thing you can do, or the wise thing to do, is to try and use these pullbacks to get some stocks that have been oversold and are on sale. You've got another one on your shopping list.
Absolutely.
Monolithic Power Systems. Why do you like it?
When it comes to semiconductors, the main one everybody talks about is NVIDIA, and rightfully so. The GPUs it sells in vast quantity at large prices is very powerful. That being said, there's many other semiconductors in that space that are attractive. One of the favorites is Monolithic Power, which you mentioned. What it does, its semiconductors preserve energy, make products more energy efficient, whether it be cars, phones, refrigerators, anything that has a semiconductor in it, it can make it way more efficient. They're not the biggest in the space. That's going to be Texas Instruments, but they've been growing much more rapidly. And I think the price of the stock over the last few years justifies why it's been growing so much. So we think that's a unique spot to be in a semiconductor, that it's priced much more reasonably, 17 times earnings, got a bit of dividend. And this would be an example of one of those stocks definitely keep on your shopping list. If the markets get more volatile and you don't have it, consider adding a little bit.
And talking of the markets getting more volatile, Glenn, it's sort of taking a sort of a bird's eye view of the entire market. Do you think that there's a Trump put? Because it feels like when the market was having a bit of a rocky time there, Trump started to soften up and say the things that were soothing the markets. The things that the market wanted to hear, like, oh, we could be flexible on some of the tariffs. Oh, there could be a reprieve for some countries. Oh, this could happen or this could happen. Sure. Is that a Trump put at play?
I am not going to try to speculate what Trump's thinking or doing. I have no idea. What I do think is that what we want to do is buy quality stocks, companies, some of the best companies, not only in the U.S., but in the world. And over time, regardless of politics or what's going on with inflation or the whatever next things come down the pike, these stocks are still going to make money. At the end of the day, these stocks are just companies. And we think there's many companies out there that are doing amazing things. Some are priced a little bit expensive, so use this to your advantage. I have no idea what's going to 12 months from now to the penny what tariffs will be on or off. But I don't think you need to know to make money in the stock market. What you need to do is be patient, have your list, take advantage of any dips. You're not going to make the money in the stock market by trying to time when it's going to drop or what Trump is going to say tomorrow or next week. It's more by being patient, owning quality investments, and over time it's going to work out.
Over time it's going to work out. I do also want to get your sense, Glenn, on what does this mean for the financial sector, which has had a roaring 2024. As we look, I mean, you like JP Morgan, but I wonder what's the call on the banks now? Because again, on the rate cycle.
Banks.
Oh, you really like banks?
We do.
Because there's so much uncertainty on the rate curve.
Yeah, but we think rates are still going to stay elevated. We also think there could be less regulation coming in the next year or two, and that could help earnings too. So banks haven't been in the best environment for the last few years. So we think it's going to either maintain or improve. Mergers and acquisitions have been a bit slow. There's a ton of opportunities, we believe, in the financial sector. Regardless of what interest rates do, up or down, there's opportunity.
But the banks have had a great run. How have they struggled in a rate tightening cycle? I mean, rates started coming down only in September of last year.
JP Morgan just had record earnings. So, I'm not going to bet against Jamie Dimon. I'm not going to put an option on a JP Morgan. I think they have plenty of room to run. Could it dip over the next few months? Sure, but we're not speculators. We don't want to speculate for our clients' money or our money. As an investor, the price earnings 12. So even though it's had a run up, look at what it's priced at. It's justified that growth, and it's still done it at an attractive valuation. So in general, we still like banks. That being said, we're very picky. JP Morgan's by far the one we own the most of. But the financial sector, I think is very attractive, as well as energy, consumer staples. But financials is right up there.
So we have a minute to go. Just to follow up, do you like just the main banks? Ex JP Morgan, is there anything else that you like? Because Goldman Sachs has gone through the roof. I think it's more than doubled. That's been the case with some of the other banks. Some of the regional banks have also done well. And so do you think that this is an area of interest for you?
The investment banking, the Goldman Sachs, we're not as big a fan just because it doesn't have the deposit base that a JP Morgan does. In terms of regionals, we think there's a huge opportunity. We're in the state of Texas, and there's a ton of regional banks. We expect in 2025 to be a ton of consolidation. And the Secretary of Treasury, in fact, I believe it was this week, if not last week, he was talking about less regulation on the regional banks, right? Some banks out there are held pretty much all to the similar standard, which doesn't really make sense to have a huge bank held to the same standard as a regional. So I think regionals could be ready for a breakout. That being said, we're not invested in them right now, but that for sure could be an opportunity.
Great conversation, Glenn. Has spoke from the heart. Thank you very much for joining us and giving us your perspective on the markets. Really appreciate your insights and thoughts. We'll take a short break. Greater Charter Markets will be coming online.